In today's trading lesson, we are going to talk about a kind of breaking news trade that involves momentum stocks, names like Peloton, Amazon, Netflix. If trading momentum stocks is of interest to you, stick around. My name is Steven Spencer. I am a partner at SMB Capital. We are a proprietary trading firm in Midtown Manhattan where we trade stocks, futures, and options. So, today's trade is what I like to refer to as the smartest dumb trade you'll ever make. And this is a trade that's been around for many, many years. It usually crops up a few times during the year, and it is a subset of a breaking news trade. So the idea behind this setup is basically there's a market leading company. They have a segment that they're a leader of, and I mentioned at the beginning a Peloton. So they have this particular segment like home exercise, or perhaps years ago Netflix market leading segment would be online streaming. And then what happens is breaking news story will happen during the day that one of the large market leaders like an Apple or an Amazon or one of these huge companies, Google, Microsoft, will come along and they're going to somehow compete with this company that's become very strong in a particular niche. Now, when you step back and you think about it, the market leader of a particular segment like a Peloton, they're the market leader, the segment leader for a reason. They figured out an addressable need, they developed a product that's popular, and they've executed really well. And so just from a pure analysis standpoint, the fact that Amazon or Apple or someone might come along and compete, that's not going to change Peloton's long-term prospects. At least it's not the vast majority of the time. Most times, when a very big company says they want to compete in a particular segment, that's fine. It's usually because they can't actually take over the leader of that particular segment, and so they have to basically develop their own thing internally. But almost never is it a situation where, to give you an example from the iPhone moment from 2007, where Apple came in and they said, you know what? The way that this sector is going right now with smartphones, Nokia, BlackBerry, this doesn't make any sense. We're going to come in, disrupt, and completely take over this segment. Or a more recent example, in the last few years, maybe Tesla. The way automobiles are manufactured, it should be electric, it should be software fully integrated. We're going to come and disrupt this segment and completely take it over the next decade. Those are the exceptions. That's very, very, very rare. What happens normally is a very large conglomerate will come along, they'll try to compete in a narrow area, and they might have some modest success, or maybe they'll even do quite well and compete with the segment leader, but they're not going to destroy that company. But that doesn't matter in terms of intraday trading if news breaks during the day, because the fact of the matter is that if you have breaking news during the day, that somebody like Apple is going to come along and compete, or somebody like Facebook is going to come along and compete, the algorithms that are scanning all of the news feeds, scanning the Bloomberg terminal stories, and using natural language processors to look for stocks to buy or sell, they're going to see that headline for that news story and that announcement, and they're going to shoot first and ask questions later. And what happens is there will be some initial sell pressure when a story like this comes out. Then human traders, short-term traders, such as the traders at our firm, may come along and they will start to trade intraday, and they will use their trading skills to pile on the short side. And then ultimately, the stock might have some bottoming action and we will look for a reversal intraday. And then over the coming days, because the stock that's being sold off is a segment leader in their particular niche, we will look for a longer term swing trade to the upside. So for those of you who are intraday traders, what we're going to look at, this is great for you. For those of you who are intraday and swing, we're going to also address the swing component, the swing setup as well. Our first example, the best example I could think of from the last couple of years was in 2018, in the middle of the day, Facebook decided to announce that we are going to start producing a dating app, and we're going to compete with the top people in the online dating space. Now, there's one publicly traded company that's controlled this space for many, many years and is dominant, and that's known as Match.com, and it's actually MTCH. So when that news broke, the algorithms hit the bids, the stock went down very quickly, and bedlam ensued. Here's a multi-day chart. What you can see is very clearly on day one, when that announcement came out at 1 o'clock or 2 o'clock or whatever it was boom, went straight down several dollars, and eventually ended up selling off some more the next day. If we actually zoom in and take a closer look at what happened, is you can see, and I've labeled this there, I've given you 3 potential action points. And the first action point is really, it's either going to be algorithms seeing the news, scanning the news, and getting short Match when Facebook says they're going to compete with Match.com. Those are the first people to get short, the algorithms. They're quicker than the humans. The humans on our desk will have scanning software that's built into our trading platform, and that scanning software usually within a few seconds will pick up on the unusual trading activity, or maybe even within a second, will pick up the unusual trading activity in Match, MTCH. And so as it's dropping a point or so, the momentum traders who trade breaking news stories will actually start to get short Match, and then watch for that initial momentum down. And then the traders who are kind of more wait and see approach will look at that initial down move in the first 5, 10, 15 minutes, look for some sort of retracement, some sort of bounce. And you can see that's where I labeled number 2. It's actually an area I circled. It went down pretty hard in that first 15 or 20 minutes or so. There was about a $2 bounce, $2 to $3 bounce. And that sort of normal retracement is where experienced traders who weren't participating in that initial momentum down move will look to see where it starts to move sideways. Because anytime you have a momentum down move intraday, there's going to be a natural retracement. One of the things to look for that retracement is, did volume hit a crescendo? Did volume really get quite high and then start to tail off again? I circled on the bottom part of that chart where the volume is being highlighted, and you see those last 2 down bars on the chart, that the volume got extremely high, and that marked the intraday low for about an hour or so. And that is where people who shorted on a momentum basis would probably start to look to cover as it starts to move sideways. But as it starts to consolidate and the sellers emerge at the top of that consolidation, some traders will start to build into a short position again, and they won't actually wait for the break of that consolidation. For myself, I'm actually looking to see which way it breaks, because in this scenario where Facebook decides that they're going to announce a competing product at some point in the future with the dominant player, my natural skepticism kicks in. And so what I'm, for the most part, looking to do is just waiting to see those sellers step down lower and a break of the consolidation and play that. And that's where even the traders that are perhaps shorting during that consolidation towards the top of the range, they're not going to get really aggressive until they see the break as well. And that's where I've labeled point number 3, where it actually breaks out of consolidation. In addition to what we see when the initial story comes out in the algorithms, hitting the bids and causing this downward pressure intraday, what you have usually in the next day or two is what I refer to as the dumb headlines. We know that a lot of publications are designed to make money by getting people to click on headlines, click on stories. That's how they make money through ads. And so we'll see after a stock like Match sells off, these online publications know that if they have headlines like, here's an example right here, Facebook is a beast unlike any other that Match Group has seen. And so that's a big headline from Business Insider. They're known to kind of puff up stories and do things like this. They've been doing that for years. But you have to think about it from the standpoint of, on day one, if something moves down intraday and then closes pretty weak, you're going to then get these headlines online. You're then going to get the financial media, the people, the investors watching TV that night, saying Match.com dropped 10% or 15%, Facebook's going to compete. And so you're going to get more people putting in orders, perhaps that are even long Match, deciding, oh my goodness, I better sell it the next morning because there's competition coming from Facebook. And that usually on day 2, if that stock closed weak, will create some further pressure. But what I referred to at the top of the video was, once you get that initial selling on day 1, once you get people jumping in on day 2 and selling some more, as long as we're coming into longer term support, we're going to start to look for sideways action over the next 2 or 3 days, maybe some sort of bounce. And then over the next week or two, pretty much erasing that down move that we saw. And so in this chart that we're looking at right here, what you can see is over the last few months, I've circled on the left side of the chart where they reported earnings, where MTCH reported earnings. It actually had good earnings, just so you can tell by the chart. It moved up in the coming days after that, from the 30s into the 40s. And then the announcement from Facebook caused it to drop not all the way down to the 34, 35 area where it was on the prior earnings, but pretty close. But on day 2, you can see it flushed into that longer term support. And then you can see in the next couple of days, people starting to nibble, starting to move sideways. And that's what it looks like. When stocks come off really hard, what it looks like after that big down move on day 1 and then some selling on day 2 or day 3 possibly, you'll start to see then a range form and a bounce attempt. And usually that, I would say most times, that first bounce attempt doesn't go straight back up. You'll have some more selling and then maybe a higher low or a retest of the low. And then the next time it starts to move up and takes out the initial bounce high, you start to have a trend and you'll go to price targets. If we look at the next chart, what you can see is I've labeled a few profit targets as it starts to bounce in the coming days. And the other thing to remember is when cooler heads prevail 3, 4, 5 days later, you'll start to see some more headlines. Match reports earnings, they gave a good outlook, they should be doing fine. And so then people see the stock starting to move up and they realize it's down well off the highs, more people will start to come back in. And then that creates kind of this uptrend working its way back into possible bounce areas. So the 3 areas that I like to trade back into the bounce areas. And so on day 2, first of all, let me just say on day 2, that's when I'm looking to put in my swing long trade. Usually right on the open, you'll put in a low. Remember in the first 15, 20 minutes of the morning, stocks most of the time will put in a high or a low for the day. And so if something had sold off the prior day and is coming off on this day 2's open, we'll look for it to put in its low right on the first 15 minutes or so. And so if something is coming into long-term support in the first 15 minutes, that's when I'll start to buy. And then I'll look for it at 10 o'clock. Is it holding above the morning high? And then perhaps add to the position there. So that's on day 2. And then my expectation is if it starts to bounce on day 3, if it gets into the first bounce area, that's a really good spot to take some profits. Now I labeled that as the first potential bounce area on this chart we're looking at because prior to match putting in its high, it had pulled back to that price. And it's all about psychology. So people are watching the stock bounce. They see, oh, it's at this pivot low. I'm going to maybe take some profits there. It takes a few people to take profits, and before you know it, it pulls back. The good thing about it is when it pulls back from that first potential bounce area, it starts to then form an uptrend. And then once the uptrend is formed and it makes another higher low, we can feel comfortable until that trend breaks to go to the next target or ultimately to the third target on the right part of the chart, where it just erases the entire down move from the announcement. The next thing we want to take a look at is what happened to match in the 2 years since that sell-off. In the middle of the chart, you can kind of see the markup area from 2018, and lo and behold, the fact that Facebook decided to launch at some indeterminate point in the future a competing product had no impact on its long-term prospects. And in fact, it's actually tripled in the last few years, or the last couple of years from that sell-off that day. It's gone from $35 to about $115 a share. And so that's where it is 2 years later. So I want to take a look at a more recent example. And actually the reason I'm doing this video, in the last month or so, it seemed like every few days there was another headline about Peloton. And so the thing you need to understand about Peloton, it's similar to, it's a momentum stock. That means it's high growth. It attracts momentum hedge funds, momentum investors. And those types of situations always attract a lot of short sellers as well. I don't know what the short interest is right now in Peloton, but it's probably pretty high, maybe lower than it was when it was in $40. Now it's over 100. Very similar to Tesla in this sense that it attracts a lot of short sellers, and the competition's always coming. And so Peloton, we just started to see headlines. It was like in August, Apple was doing something with fitness and they were going to compete. Peloton shares dip then recover after report possible new competition from Apple. On that Apple announcement, what was very different was that news came out before the market opened. And so before the market opens, you're not going to have those algorithms scanning the Bloomberg headlines to short, because they are going to trade during normal market hours. So when a headline comes out in the pre-market, most of your selling, your people trying to get short and take advantage of those headlines, are going to be human traders. And so human traders, you can see in the middle of the chart there, I've circled it, it's gapping lower a few percent, and they're shorting. When the market opens, if there's no sell orders materializing from the algos and it goes right up, those human traders that shorted in the pre-market, they're going to have to cover. So this is a very different scenario. Very important to remember, when the breaking news headline comes, if it's not intraday, if it's pre-market, and human traders are shorting in the pre-market, especially a stock where you can look on the chart, it had already sold off a few days before, so it was already ready to have a bounce. And so you should be ready to take advantage of that. If it gaps lower right on the open, if the first move is up and gets above the pre-market high, you should immediately be looking to buy and looking for what it's called filling the gap, going positive on the day. Those were the initial headlines, and then we got some more headlines where there was going to be some Amazon competition. This was like a couple of weeks later. Here's all the headlines. Amazon competition, low price spike, oh my God, Amazon's the biggest retailer in the world. What's going to happen to Peloton? Their business model is over. No, of course that's not the case. Amazon, as big as they are, have announced a ton of initiatives over the years, and the one that comes to top of mind is they were going to do a smartphone, which failed miserably. And so this is an example of where momentum hedge funds and investors, they love headlines like this, because if they happen outside of market hours and the stock is going lower, they are ready to buy, and the stock will move higher. And in fact, we talked about this one in the morning meeting. Somebody asked in the morning meeting, and by the way, what we do in our morning meeting is we find the most in play stocks for the day. The way we do this is we use our scanner. We have a pre-market scanner where it identifies things that are moving in the pre-market, what the short interest is. If you want to learn more about the pre-market scanner and our stock selection process, check out the 2-hour free workshop, tradingworkshop.com. As long as you are in the right stocks each day, I found that you're much more likely to be consistently profitable. Experienced intraday traders are going to be positive 80% of the days if they're in the right stocks. The next video I do, I will talk about the last few months where I only had one negative day and why that is stock selection. Learn about it more, tradingworkshop.com. Okay, so getting back to the breaking news on Amazon, there's going to be this competing bike. Oh my goodness, oh my gracious. It's gapping lower in the pre-market. In this case, if we zoom in on the open, it's always about the first move. And so in this case, the first move was to the downside. And so the way that we look at it is in our pre-market prep is, what is the key level we're looking at? And in this case, below $90, we knew 89 and 88 was support. And so what I basically said was look, if it takes out the pre-market low and is below $90, you can trade it on the short side, but understand that if it gets back above $90 and starts to hold and then moves back above pre-market resistance, we can look for a reversal, because this is not news that the momentum hedge funds are going to take seriously. In fact, a few days later, Amazon, the whole thing ended up being a little bit of a fraud, because the company that said it was an Amazon bike, Amazon issued them, I think, a cease and desist order. It wasn't even Amazon. That company was trying to get on, play off Amazon's name or something like that. But regardless, from an intraday perspective, the news comes out in the pre-market before the market opens. I've circled that little area for you. I call it reversal bars. The reason why 2 bars is important, sometimes you'll get one green bar, then it'll roll over again and take out the the morning low. It actually will be a good short. But once you have that second green bar on the 5-minute and it closes there, at that point, and if it's above $90 a share, you're looking for it to actually move higher for the day. And I want to take a look at a higher time frame. The way that we talked about it was, if it actually closes at the high, because it had already sold off a few days before, this is one where we can look for it to trend up and work its way back up to $100. And so just to give you a recap of this particular trading setup, competition, there's announcements from competition, and it triggers knee-jerk reaction and selling. That knee-jerk reaction and selling, the first people shorting is always going to be algorithms, but you can have scanning software based on volatility, based on a bunch of different things. We do it internally on our platform. Obviously, if you're using TradeStation as a platform or you're using a scanning technology, you can set those scans up, and you can, in the first few minutes, jump on board on a momentum trade. My favorite trade intraday is after that first initial momentum down, whether it's 10 or 15 minutes of down, I watch the retracement, normal retracement rules apply, 25, 30% retracement, look for it to start to move sideways, and then look for that second leg to the downside. Much more likely to work, obviously, intraday. Always a good swing long. As I said at the beginning of the video, it's 1 out of 100 times where we have Apple's coming along with an iPhone or a Tesla's coming along with an electric car integrated with software and batteries and all these things disrupting an industry. What happens 95+% of the time is one of these big players comes in, whether it's a Facebook or an Apple or an Amazon or a Google. They're not going to destroy the sector leader. They are going to create knee-jerk selling, and the smarter funds, larger retail investors, they're going to step in the next few days, and these stocks are going to bounce. And you're going to look back in a couple of weeks, and these stocks are going to retest the high, and depending on overall market conditions, how strong is the market that you're in, and how strong is the uptrend in that particular stock at that particular time, perhaps not even bounce back to where it started from, but then start the next leg higher. Hope you learned something here. Look out for the next time this happens. It usually happens a few times a year. Please take advantage.